Picture this. You finally get the raise you've been working toward for 2 years. Not a small one either. A real raise. $12,000 more per year. You do the math in your head. That's an extra $700 a month after taxes. You tell yourself this is it. This is when things finally change. You're going to start saving properly, pay down some debt, maybe even start investing. 6 months later, you look at your bank account and it looks almost identical to what it looked like before the raise. And you have absolutely no idea where $700 a month went. This is one of the most common and least talked about financial experiences in America. And it's not about discipline. It's not about being irresponsible. It's about a system, or more accurately, the complete absence of one. And if you don't fix the system, no salary in the world will fix your finances. First, let's talk about what's actually happening. The raise disappears phenomenon even has a name. Economists and behavioral finance researchers call it lifestyle inflation or lifestyle creep. As your income goes up, your spending quietly rises to match it, and the gap between what you earn and what you save stays roughly the same. And this is happening at every income level, not just to people who are struggling. According to civic science data, 17% of Americans earning over $100,000 per year have no money left after paying their monthly expenses. According to PYMTS Intelligence, half of high earners, again, people making $100,000 or more, are living paycheck to paycheck as of early 2025. These are not people with cash flow problems. These are people with system problems. 6-figure income, no financial traction. The U.S. personal savings rate right now is approximately 4.6%. That's the average across all income levels. Top earners save 15 to 25% of their income. Bottom earners often save nothing at all, or worse. But here's the thing. The research consistently shows that the difference between those two groups is not primarily income, it's behavior and structure. Someone who earns $50,000 and automatically routes 15% to savings and investments ends up wealthier than someone who earns $95,000 and saves whatever happens to be left at the end of the month, because for the second person, almost nothing is ever left. Here's why willpower alone doesn't work. This is where most financial advice gets it wrong. It tells you to be more disciplined, track every expense, say no to things, build better habits. And look, none of that is bad advice, but it misunderstands the core problem. The human brain is not built for this. When money sits in your checking account, it feels available. Whether it's earmarked for savings or not doesn't matter to your brain's decision-making in the moment. It just sees money that is present and accessible. And that money has an enormous number of competitors. A dinner with friends, a subscription you barely remember signing up for, a purchase that felt reasonable at the time. Every dollar you intend to save but don't automate has to survive that gauntlet every single month. Most of them don't make it. The proof is in the data. When companies switched their 401k plans from opt-in to automatic enrollment, meaning employees were enrolled by default instead of having to choose to sign up, participation rates jumped from around 60% to over 90%. The same people, the same salaries, the same financial situations. The only thing that changed was the default. And that one change, in some companies, nearly doubled the number of people saving for retirement. Automation doesn't just help you save more. According to behavioral finance research, people who automate savings accumulate between 1.5 and 3.5 times more wealth than people who transfer money manually, not because they earn more, not because they're smarter investors, because the decision is made once and executed forever, instead of being re-litigated every single month against everything else that wants that money. So what is the actual system? Let me walk you through it. This is the framework. It's not complicated. The reason most people don't have it is because nobody ever explicitly laid it out for them. Step 1. Flip the sequence. Most people operate on a simple mental model. Income comes in, bills get paid, things get bought, and whatever is left over goes to savings. This is the wrong order, and it is specifically this ordering that causes the $700 raise to disappear. The correct sequence is: income comes in, savings and investments move automatically, then you live on what's left. This is called pay yourself first. It's been standard financial advice for decades, but the key word that most people miss is automatically, not I intend to save first. Automatically, before you can see it, touch it, or spend it. The day your paycheck lands, a predetermined amount leaves for savings and investment accounts. Then you budget around what remains. When you do this, two things happen. First, you actually save the money. Second, your brain quickly adjusts to treating the smaller number as your real income because that's all it ever sees in your spending account. The money you don't see, you don't spend. Step 2, set up the actual automation, account by account. Here's the concrete setup. Your first automated transfer is to your employer's 401k, set at a percentage that at minimum captures your full employer match. This should already be in place. If it isn't, that's the first thing you fix today. Not tomorrow, today. Your second automated transfer is to a Roth IRA or a high-yield savings account, depending on whether you have an emergency fund yet. If you don't have 3 months of expenses saved, that comes first. Set the transfer for the day after payday so it happens without you doing anything. Your third automated payment is every recurring bill you have. Utilities, subscriptions, rent if possible. Pay these automatically so they're never late and never require a decision. Decision fatigue is real. Every financial decision you remove from your monthly plate is one less opportunity for a mistake. What's left in your checking account after all of this is your actual spending budget. And here's the beautiful part. You don't have to track it obsessively. You can spend it. The important stuff already moved. Step 3. Automate the raise. This is the step almost nobody does, and it's the reason raises disappear. The next time you get a pay increase, before your new salary ever hits your account, increase your automatic savings transfer by at least half the raise amount. If your take-home goes up $400 a month, redirect $200 automatically to savings or investments before you ever see it. You'll still feel the raise. Your life gets $200 better, but you also capture half of it permanently. This is the single highest leverage move in personal finance, not because the dollar amount is huge on day one, because of what it does over time. According to savings rate analysis, on a $75,000 income, each 1% increase in your savings rate equals approximately $75,000 in additional retirement wealth over 30 years at a 7% return. If a raise lets you bump your savings rate from 8% to 13%, that 5 percentage point swing is worth around $375,000 at retirement from one raise that you redirected before your lifestyle had time to absorb it. Step 4. Build the one-page financial dashboard. Here's the honest truth. Automation handles 80% of the work, but you still need to check in. Not daily, not even weekly. Once a month, spend 20 minutes looking at 4 numbers. Number 1, your savings rate this month. Total saved divided by total income. This is your single most important financial metric. Not how much you have, the percentage of what you're capturing. Number 2, your net worth. Assets minus liabilities. Does this number go up every month? It should. Number 3, your investment account balance. Is it growing? Are your automatic contributions landing? Number 4, your emergency fund. Is it between 3 and 6 months of expenses? Too low is a problem. Too high means excess cash is sitting in a savings account earning 4 to 5% when it could be invested. That's it. 4 numbers, once a month. The system does everything else.
Now, let me address the pushback I already know is coming. I can't afford to save right now. My expenses are too high. I hear this a lot, and for some people in genuinely tight situations, it's real. But for most people reading this, the honest answer is your expenses have expanded to fill your income, not because you're irresponsible, because that is what money does when there's no system telling it where to go first. Start with 1%. If you earn $4,000 a month after tax, that's $40. Automate $40 into savings the day your paycheck hits. You will not feel $40. Your life will not be meaningfully different, but you will have started the system, built the infrastructure, and established the habit that you can scale. Then, when the next raise comes, or when a subscription cancels, or when a bill goes away, redirect it. Don't let it absorb into your general spending. Redirect it. The system grows over time exactly the same way an investment portfolio does. Slowly, then all at once. Here's the truth the personal finance industry should say louder. Your salary matters. More income gives you more to work with. But the data is unambiguous. People earning $100,000 are going broke, and people earning $55,000 are quietly building real wealth because one group has a system and the other doesn't. The raise you're waiting for won't fix this. Earning more money without a system doesn't build wealth. It builds a more expensive version of the same problem. The fix is not more income. The fix is automation, a system that moves the money before your brain can negotiate with it, a default that makes saving the path of least resistance instead of the path that requires monthly willpower you don't always have. Build the system once, let it run, and then every raise, every windfall, every bill that goes away, feed it back into the machine. Your salary is not the problem. It never was. If this hit differently than you expected, hit subscribe and drop a comment below. Do you have a system right now, or have you been relying on willpower to make it work? I read every single one.